Hey folks, welcome to another product review at Finominal. Today we're going to look at one of the oldest and largest multi-strategy hedge fund ETFs, specifically IQ's Hedge Multi-Strategy Tracker ETF. Now, the ETF has been around for more than a decade. It has around $600 million under management, and it charges 55 basis points. Now, multi-strategy hedge funds have become quite popular in recent years based off strong performance. And these are names like Citadel, like Millennium. And effectively what they do is they, as per the name, they combine different teams and strategies into one stream of uncorrelated alpha. Now, let's see how well QAI does and what it offers. Now, the first thing that we're going to do is we're going to try to find out what are the drivers of the product. And so we're going to go to our alpha analyzer tool. And it doesn't really make sense to look at a benchmark for such a product because that likely should be cash plus 200, 300, 400 basis points. But let's go to a return-based factor exposure analysis. And so what we're doing over here, we're simply looking in terms of what have been the major exposure to asset classes over time. Now, what we do see is that there has been consistently positive exposure since 2011 to the S&P 500, which represents equities, to bonds, slightly negative exposure to the US dollar index, and flat exposure to commodities. Now, that's actually quite concerning because you do invest into hedge fund and especially multi-strategy hedge funds to get returns uncorrelated to the stock market. But we can see here that betas to the S&P 500 are positive and consistently. We can confirm that by looking at the risk sources over time, where we see over the last, 13 years or so, the S&P 500 contributed the majority of the risk. Now, the ETF is trying to generate diversification benefits, but that is naturally difficult if most of the exposure is coming from equities. Now, let's evaluate that. Perhaps this is wrong or misleading, and perhaps this product has generated diversification benefits. So we're going to look at QAI on our diversification booster. And the first thing that we're going to focus on is the correlation to stocks. Now, we do see that over the last 15 years, the correlation to stocks was 0.7, which is quite high. This is similar to an EM bond index or some fixed income instruments that are somewhere between treasuries and equities. We can see slightly higher correlation to bonds. We can also see that the downside beta to the S&P 500 was higher than the upside beta, which is not particularly attractive. Then finally, just to simulate in terms of would this product have generated diversification benefits for an equities portfolio, we can look what would have happened if you would have added 25% to a portfolio comprised exclusively of the S&P 500. Now we do see that the Sharpe ratio over the last 15 years was 0.88 for the S&P 500, which is quite high. Historically, it's a lot lower, but the S&P 500 was largely in a bull market. Now, if you would have added 25% to QAI, that Sharpe ratio actually would have decreased. Now, stated differently, it didn't generate any diversification benefits. It actually detracted. It generated negative diversification benefits. So that's not particularly favorable for this IQ Hedge multi-strategy tracker ETF. And we can kind of wrap or even show a simpler way of seeing if this product offers anything unique. And this is observing if the product can be replicated simply via equities and cash. Now, we already know that there's equity in this product, even if it shouldn't have any. But what we can demonstrate with this tool called Time Machine that if we assume the same volatility and we only have the S&P 500 in cash, could we achieve something similar to this fund, this ETF? And the interesting part about that is that if you look at this chart, you can see the performance of QAI. You can see the performance of this replication portfolio that only consists of 36% allocation to S&P 500, 64% allocation to non-interest-bearing cash, that this would have virtually exhibited the same trends, but a much higher total return. And we can see the volatility in both cases was 5.2%, but the CAGR was almost double for this equities plus cash replication. So this is a very simple way of looking at complicated products that often represent diluted equity exposure. And that kind of almost summarizes our product review, that QAI is opposed to, well, perhaps it does track multi-strategy hedge funds. I don't know the methodology they're using, but the product you're getting, the exposure you're getting, is just equities and cash. And that, of course, is non-diversifying, and it's not worth paying 55 basis points for that. Hope that was helpful. Have a nice day.